What if I told you that just $50,000, less than the price of a used car or a down payment on a small apartment, could start earning more money for you than your full-time job? Not in 30 years, not when you retire, but starting right now. Imagine waking up every month to cash flowing into your account, not because you worked overtime or begged your boss for a raise, but because two powerhouse ETFs, SCHD and JEPQ, are quietly paying you like a second salary. Most people think passive income takes millions to build, but the truth is, the right investment can outperform your day job faster than you think. The real question is, which ETF is strong enough to do it? The reliable dividend machine SCHD, or the monthly income monster JEPQ. Today, we're breaking down the numbers, the income, the growth, and the real-life math behind how $50,000 in these ETFs could eventually beat your full-time job forever. Welcome to WealthEchelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs, and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button, and don't forget to turn on the bell for updates on all our latest content. $50,000 in SCHD or JEPQ, which one can outperform your full-time job? Imagine waking up one morning and realizing that a portion of your income no longer depends on your boss, your desk, or your 9-to-5 schedule. Instead, it's coming from a portfolio quietly working in the background, paying you every quarter, every month, and every year without you clocking in a single hour. This is the dream many investors chase when they ask a bold question. Can $50,000 invested in a dividend ETF outperform what I earn from a full-time job? And more specifically, which ETF has the better potential to do it? SCHD or JEPQ? This article breaks down that comparison in a clear, long-form analysis to help you understand which fund has the power to grow your wealth faster, pay you more consistently, and potentially replace your day job earnings. To answer this question properly, you need to understand the two paths to financial freedom these ETFs offer: income and growth. SCHD, the Schwab U.S. Dividend Equity ETF, is the classic high-quality dividend performer, stable, reliable, and historically one of the strongest dividend ETFs in the U.S. market. JEPQ, on the other hand, is a modern income machine designed to pull extra cash out of the tech-heavy NASDAQ using covered call premiums. One focuses on dividend consistency, the other focuses on income generation through option strategies, and both can deliver impressive returns, but they do it in dramatically different ways. Let's start with SCHD, the ETF that millions of long-term investors swear by. SCHD is built on a simple, powerful formula: buy companies with strong balance sheets, steady cash flow, and a long history of paying dividends. It's the kind of ETF that selects businesses capable of staying profitable through recessions, interest rate changes, and market volatility. When you invest $50,000 into SCHD, you're essentially buying a basket of America's strongest dividend stocks. Companies like Pepsi, Amgen, Verizon, Home Depot, and Coca-Cola. SCHD doesn't chase hype or rapid price movements. It focuses on quality and sustainability. And over the past decade, this strategy has delivered surprisingly competitive returns compared to growth-focused funds. With a yield typically around 3.5% to 4%, SCHD provides reliable quarterly income. So, if you invested $50,000 today, your expected annual dividends would be around $1,750 to $2,000. That's nowhere near a full-time salary, but that's not the whole story. SCHD shines because of its dividend growth. It has historically grown its dividend by 12 to 15% annually. That means your income from SCHD gets larger every single year, even if you never add another dollar. Over 10 years, that $50,000 could realistically turn into around $100,000 or more, depending on market conditions and reinvestment, and your annual dividends could jump to $4,000 to $6,000. Still not a full-time job replacement, but now you're earning a healthy supplemental income, one that grows on its own, requires no labor, and comes with increasing value over time. Then we have JEPQ, the income-focused NASDAQ powerhouse launched by J.P. Morgan. JEPQ takes a completely different approach. It invests in big tech, names like Microsoft, Apple, Nvidia, Amazon, but also sells covered calls to generate extra income. These option premiums are then returned to investors as monthly distributions. The result? JEPQ often yields 8% to 10%, sometimes even higher during volatile market periods. That means your $50,000 investment could return $4,000 to $5,000 per year in cash from day one. Monthly income instead of quarterly. A yield double or triple what SCHD provides. For many investors, this feels like passive income on steroids. But higher yield doesn't automatically mean better performance, and this is where the comparison becomes critical. Covered call ETFs like JEPQ give up a portion of price appreciation in exchange for higher income. That means when the NASDAQ rallies aggressively, JEPQ may lag behind growth-focused ETFs such as QQQ or VGT. But at the same time, during flat or choppy markets, JEPQ can outperform because it continues generating income from option premiums. So the real question becomes, do you want more income now or more long-term growth later? Because SCHD and JEPQ are built for completely different types of investors. To understand which one can outperform your full-time job, we need to break down the numbers realistically. A full-time job typically pays anywhere from $20,000 to $60,000 per year, depending on your country and field. With a $50,000 investment, even the highest yield ETF in the world won't immediately replace that income. But what they can do is build a passive income engine that grows every year without requiring extra work. And eventually, that engine can surpass your active job earnings, if you give it time. Let's compare long-term projections. Imagine investing $50,000 in SCHD and letting it compound for 15 years. With a reasonable total return assumption of 8% per year, your portfolio grows to around $158,000. If dividends continue growing at their usual pace, you could be earning $8,000 to $10,000 per year just from dividends alone. That's tax-advantaged income in many jurisdictions and requires no selling, add more contributions or reinvestment, and the number gets even bigger. Now look at JEPQ. With an average total return of 6% to 8% per year and a high yield, your portfolio could grow to around $120,000 to $150,000 over the same period. But the key difference is that JEPQ would have paid you tens of thousands of dollars in income along the way. If the average yield remains around 9%, your yearly income by year 15 could reach $11,000 to $13,000. That means JEPQ might outperform SCHD in income, while SCHD may outperform JEPQ in long-term growth. Another factor is reliability. SCHD's dividend is backed by company profits and decades of financial stability. JEPQ's yield is backed by option premiums, which depend heavily on market volatility. If volatility falls, yields could shrink. If tech stocks tumble, returns could drop. SCHD, by comparison, is less volatile, less dependent on the tech sector, and built to weather economic downturns. So which one can outperform your full-time job? The answer depends on your time horizon and your goal. If your goal is fast income, JEPQ is the clear winner. The monthly cash flow is unmatched for a mainstream ETF, and starting yields of 8 to 10% are enough to create meaningful income immediately. A $50,000 investment paying you $4,000 to $5,000 per year is equivalent to a part-time job without working. And with reinvestment, your income snowballs faster. But if your goal is long-term financial freedom, SCHD wins the race. Its dividend growth, Price appreciation, stability, and compounding potential can turn $50,000 into a much larger nest egg. Over 20 years, SCHD has the potential to outperform JEPQ significantly in total returns. And total returns are what ultimately give you the power to replace your full-time job with investment income. Another perspective. Imagine combining the two. If you put $25,000 in SCHD and $25,000 in JEPQ, you get the best of both worlds. High monthly income now and strong long-term growth later. Many income-focused investors follow this hybrid approach because it creates balance across economic cycles. To fully understand the idea of these ETFs outperforming your full-time job, you must shift your thinking from salary to assets. Your job pays you in hours. These ETFs pay you in ownership. Your boss can fire you, but SCHD will keep paying its dividend. Your company can change your hours, but JEPQ will keep delivering monthly income. Your job gives you security today. Your investments give you freedom tomorrow. The real power isn't in $50,000, it's in consistency. If you add money gradually, reinvest dividends, and let compounding do its work, you could reach a point where your ETF income surpasses your work income. And that's when your portfolio officially outperforms your job. Ultimately, whether SCHD or JEPQ outperforms your full-time job depends on how you define outperform. If outperforming means more cash flow, JEPQ wins. If outperforming means growing your net worth, SCHD wins. If outperforming means creating a passive income stream that replaces your job over time, both can play a role, but only if you stay invested long enough to let compounding do its magic. In the end, $50,000 won't replace your job tomorrow, and that's the honest truth most people never hear. But what that $50,000 can do is start working for you in a way your job never can. When you put money into an ETF like SCHD or JEPQ, you're not just investing in the stock market, you're building a system that earns money quietly, consistently, and automatically. These ETFs don't get tired, they don't call in sick, and they don't ask for weekends off. They operate 24/7, generating dividends, premiums, and long-term growth while you sleep, work, relax, or travel. Over time, this system becomes something far bigger than a side income. Your SCHD dividends grow year after year, rising like a staircase toward financial independence. Your JEPQ monthly payouts stack up like a second salary, giving you cash flow even in flat or uncertain markets. And if you reinvest instead of spending, those small income streams start compounding, turning $50,000 into $75,000, then $100,000, then $150,000, and eventually a portfolio powerful enough to pay you more than your 9-to-5 ever did. So no, $50,000 won't change your life overnight, but it can start the process today. It can grow into a financial engine that never stops, never slows, and never asks for approval. And one day, maybe sooner than you think, that engine can outperform your full-time job so completely that your paycheck feels optional. Because a job pays you once, but a smart investment pays you forever.
Thanks for watching Wealth Echelon. We hope you found valuable insights that will help you on your investing journey. If you enjoy the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.